If you invest in the financial market, you are more likely have made those investing mistakes. Most of the mistakes are driven by your emotions. We call them emotional mistakes. Number 1. Buy highs, sell lows. As an investor, we all want to buy lows and sell highs. That's how we make money from investing. But why many of us do the opposite? Buy highs and sell lows. We buy highs because we FOMO, fear of missing out. We all remember the GameStop trading during the meme stock frenzy at the beginning of 2021. When the stock price went up hundreds of times within a few weeks, many people jumped in and bought the stock at top prices. Later, when the stock price dropped over 80% within a couple of days, people sold all their stock at the lowest price. This is why we buy highs and sell lows. Number 2, overconfidence. Don't confuse a bull market with your investment picking skills. When everything you buy goes up, some people start to feel like they are smarter than the market. During 2020 and 2021, most investment went up significantly, especially if you bought cryptos like Bitcoin. You are doing pretty well until you experience a market correction or a bear market. You probably think you can always beat the market. This is overconfidence. Number 3, overtrading. Investing on the financial market, most of us are investors, not traders. However, some people think they can beat the market and beat the Wall Street, so they actively trade their part or entire portfolio. Historical data shows that many experienced traders lost money on their 80% trades. So you should never actively trade your entire portfolio. If you do want to actively trade some stocks or cryptos, make sure it's not more than 10% of your portfolio. The rest of your 90% portfolio should be well diversified with assets allocation. Number 4, all in or all out. Both all in and all out are terrible investment strategies. No one can time the market perfectly, and being entirely out of the market will almost certainly result in missed opportunities. S&P 500 has gained over 1,500% since 1989. If you were out of the market during this period of time, you missed the lifetime wealth growth opportunity. Well, you may ask, how can we avoid those investing emotional mistakes? As we are humans, and we have emotions, but there are strategies we can use to avoid those mistakes. First is to understand your risk tolerance. Then build a well-diversified portfolio to match your risk tolerance. In this way, you will be less panicked when the market crashes. If you FOMO, fear of missing out on some hot stocks or cryptos, you can scale in and buy less at a time to avoid buying at the top of the market, but still participate. Same idea. If you fear of the market collapse cause you to sell near the bottom, like in March 2020, you can scale out and sell a small part of your portfolio. This way, if the market continues to fall, you can feel good that you preserved some of your gains. And if it bounces back, you won't miss out the recovery gains.